It's Tuesday, September 7th. Welcome to Market Foolery. I'm Chris Hale. With me, it's not Monday, but it's the start of the week at Market Foolery, so it's Jason Moser. Thanks for being here.
Howdy, howdy. How's everything going?
Going all right. Hope all the dozens of listeners had a good Labor Day weekend. Shana Tova to all those celebrating Rosh Hashanah. We're going to talk allocation strategy, but first we're going to do something we have not done in a while. Longtime listeners will remember this. It's a little thing we like to call yes, no, maybe so. 3 stocks. One is a yes, one is a no, and one stock is sitting right there on the fence. And we're going to get through all 3 of them. And let's start with the yes stock, Elastic, ticker symbol ESTC. This is, if I understand it correctly, because I know you've mentioned it a couple of times, software as a service, but it's built around search. Elastic is about a $15 billion company in terms of market cap. Why does this look like a yes to you right now?
Yeah, well, I mean, you know how I feel about Cloudflare. I think I've been pretty clear about that on these shows, and I'm starting to feel that way about Elastic too. And remember, Elastic develops software and services that enable users to search through structured and unstructured data for all sorts of consumer and enterprise applications. And so the thing is, when you say, "Oh, Elastic's in the business of search," and immediately, and rightly so, your mind should go to a little company called Google, right? I mean, there is this search engine called Google that does pretty darn well in the search industry. The interesting thing about Elastic, as I mentioned, the enterprise application, Elastic's customers are companies, they're businesses, right? They're focused on helping enterprises utilize data and search in order to make better decisions, ultimately. And so they had a very focused customer base and therefore market opportunity, and we've seen efforts from companies, including Google, including Alphabet, to try to gain some traction in the space, and they really haven't they really haven't made too much progress. Now, I attribute that partly to the ongoing success of Elastic, but the technology that they've built ultimately is working very well. 93% of their revenue is tied to subscriptions, and as the customers get larger, as their customers get larger, so does their relationship with Elastic. And just to put some context around that, more than 45% of customers with at least $1 million in annual contract value subscribe to all 3 of Elastic's core solutions. And so I think that certainly indicates not only some strong network effects at play there for the business, but ultimately that they're doing something well. And ultimately that can result in higher switching costs, which can ultimately beget some pricing power as time goes on. We look at the most recent quarter, and the key performance indicators all tell a story of a business that's executing. I mean, total subscriber count, total subscription customer count was over 16,000. That was versus 15,000 just a quarter ago and 12,100 a year ago. The total customer count with annual contract value of greater than $100,000 was over 780. That was up from 730 a quarter ago and 630 a year ago. And better yet, that growth is actually accelerating. And so we're seeing here just a company that is focused on one particular market opportunity. They're executing very well within that market opportunity. And I mean, ultimately, you're talking about a market opportunity that all estimates have in the neighborhood of $50 to $75 billion today. Elastic just seems like a business that is poised to continue capturing a lot of that share based on the metrics that we're seeing today. And I mean, when you look at their customers, I mean, these are big customers. These are customers that folks would recognize. I mean, you're talking about companies like Adobe and Shopify, a little company called Microsoft, Etsy, Verizon, Netflix. I mean, Elastic is serving all of these businesses to help them use their data, sift through that data, and make better decisions. It just, to me, strikes me as a business that's going to become only more relevant here as time goes on.
When we were talking on Motley Fool Money last week, and I was asking you and Andy Cross about what's a stock you would have on a short leash, you talked about Bill.com just because of the valuation of Bill.com. Elastic's not profitable. The stock's close to a high, that doesn't put you off, or do you say all the more reason to have a longer time horizon?
Well, I would say it is definitely all the more reason to have a longer time horizon. I'm glad you mentioned Bill.com because, Elastic, yes, it is still unprofitable. Stock trading somewhere in the neighborhood of 30 times gross profit today. And I think when we were looking at Bill.com last week for the show, Bill.com, on the other hand, it was like 150 or something, 150 times gross profit. So there's a discrepancy there that is pretty mind-bending. So I certainly would not call Elastic a steal or cheap or anything like that. But as I've said before, I think when you look at companies that are really tackling big problems, issues where demand for that solution is high, and I think that parsing data at the enterprise level is certainly the demand for that is very high. You give them a little bit more leeway to do their thing when it comes to the financials and the valuation. I think this is a business that does require a much longer term outlook there, but that really plays right into how we invest anyway. So the valuation doesn't trip me up too much today. I think it's an indicator that the company is executing well. Perhaps it's worth buying this one in thirds, as we talk about. Buy a little bit today and then buy a little bit later and then maybe a little bit later. You don't have to buy it all at once. But yeah, I can certainly understand the valuation concerns there, but that certainly seems to be a very widespread problem in today's market too.
The stock you've got as a no is, it does not have the quote-unquote problem of being at a high. In fact, I'm sure there are some people who look at FSLY, which is trading within shouting distance of a 52-week low, and they think, this, FSLY could be a value play right here. Why is it not only not a value play for you, it's one where you're like, no, not interested? Because, they're in an industry that is a growth industry.
It is. Yeah, there's no question. When we talk about edge networks and content delivery networks, FSLY has been a name that has bubbled up to the surface for many investors for a while. I think ultimately, and FSLY was a business. It was a business I was interested in for a while. I was looking at FSLY and Cloudflare and trying to come to the conclusion as to which one I liked more. And ultimately, as you could guess, I went with Cloudflare. FSLY, to me, this is a business where the thesis has changed. I think that we're looking at a situation here where their technology is proving to not be a competitive advantage, and in this line of work, it really has to be. I've always had concerns with their usage-based revenue model. I felt like that was very limiting. And when you compared that with a business like Cloudflare, which had adopted not only usage-based, but contractual and subscription offerings, they were meeting their customers on all fronts. Not to mention they do more things than FSLY does anyway. It's beyond just an edge network. But then, one of the real tells for me, just about a year and a half ago, founder and CEO Artur Bergman stepped down, and that was in the midst of a business that was starting to witness some headwinds. Right, there was the TikTok relationship that dissolved. That was a big contributor to their top line. And when you fast forward to today, growth has hit a wall. They just recorded 14% top line growth last quarter for a business like this that's valued the way it is. Again, one of these newfangled tech companies with no real earnings, and the market is kind of taking a little bit of a greater leap of faith with some of these. This is one where 14% top line growth ain't going to cut it. Now, part of that is, I think, due to the fact that this thesis has changed a little bit. I think they are succumbing to some of the competition out there. Businesses like Cloudflare delivering better products and services, but that growth, it's playing out on the top and the bottom line there. Margins continue to compress. And so ultimately, when I look at FSLY, I want to make sure listeners understand. I'm not saying that FSLY is going to zero. Okay, that's not what I'm saying here. It strikes me as a business. It's a company that's in need of a suitor. And it's not totally clear who that would be. We'd heard some rumors a time ago that Cisco might be interested. Perhaps they're just waiting for another shoe to drop to see if they could get a better deal. But to me, it's starting to feel like FSLY is a business that's ultimately it's looking for a suitor. And we've said on this show many times, acquisition, it's fine if it happens. Sometimes it's a nice bailout. Don't discount that possibility there. But it's not an investing thesis. I wouldn't buy something like a Fastly today based on the idea that it's going to get acquired. It very well may. I think it probably will. But I think that the competition in this space is ramping up such that given the leadership change and ultimately what I think they're going to have to make a pivot in regard to their revenue model, they're going to have to get away from that usage-based model. I think that does hold them back. But when you put all of that stuff together, to me, it feels like the thesis is just has really changed here, and investors need to be aware of that.
You look at the 25-year track record of the acquisitions that Cisco Systems has made, and I guess if you're a shareholder, take comfort in the fact that if they end up buying Fastly, they've overpaid far worse for other businesses in the past couple of decades.
Yes.
Let's move on to one that when you and I were talking this morning, and you were like, I'm on the fence on this one. I was like, oh my God, so am I, which is why I'm really happy and excited to talk to you about Lemonade, ticker LMND. The insurance business is similar to Fastly's got about a $5 billion market cap. Lemonade a little smaller, about $4.7 billion. This is one I literally have written down on a Post-it note with a question mark because a lot of people we work with like this business, are big fans of it, both as consumers and as investors. I am right there with you on the fence.
Yeah, and I got a good chuckle out of that this morning when we were talking about it because obviously we did not put our heads together before that meeting, and you're right. It is one that a lot of folks here at the Fool like. My partner in crime for a Monday industry focus show, Matt Frankel, he's a fan. Definitely has talked about it a number of times on the show, and I understand that. To me, it is truly one where I'm totally on the fence there. I can't really make up my mind. I like the idea in concept, right? Lemonade is utilizing artificial intelligence and machine learning to ultimately make better decisions. And that really is what the insurance business is all about, making good decisions regarding the business that you write. And it's a massive market opportunity, right? Worldwide, you're looking at insurance as a $5 trillion industry. And it's one that is very legacy ridden, right? It's just one that's they've been doing it the way they've been doing it forever. And it's like, well, why do you do it that way? Well, that's just the way we've always done it. Maybe there is a way to do it better. And that seems to be what Lemonade is trying to exploit. But what we've seen certainly throughout our time here on these shows and with our services here at the Fool is insurance is a very hard business. It seems simple in concept, but to run an efficient and effective insurer to where you're pleasing your customers, you're making it happen for investors, and now obviously so many companies focused on really ultimately making the world a better place and looking out for all stakeholders, which I think is great. Those are all things that you have to take into consideration. And so, when you look at the numbers, a year ago in the second quarter of 2020, their customer base was primarily renters, right? They sold renters insurance. That represented about 75% of the business. And then homeowners accounted for the balance of that. Now, they've done, I think, a tremendous job in diversifying away from that renter base. And so by the end of the first quarter of 2021, that renter share was down to 56%, with homeowners representing 30%. But then they've also introduced pet insurance. They've introduced life insurance, right? So you've got pet representing 13% of business last quarter. And they're going to continue to roll out new offerings. Automobile is going to be another opportunity for them. And it sounds like customers, for the most part, like the interface, like the brand, right? It seems to be fairly frictionless, easy to access, mobile, digital. Those are great things. You look at their business model, on the other hand, and it kind of makes you wonder, at least a little bit, because ultimately the way they run their business is that they take 75% of the premiums they collect, and then they purchase reinsurance ultimately to handle the insurance, right? So they're kind of a middleman in that regard. The other 25% is set aside to cover operating costs and hopefully generate a profit. They also focus on donating excess funds to charity, which is great, I think. Now, when I mention that 75% number, that to me, I start thinking, okay, well, if they're ultimately depending on if their business is ultimately depending on purchasing insurance from other insurers, well, then that puts some of the power, a lot of the power, in those other insurers' hands, and they can start to dictate a little bit more pricing as they see fit. Now, the flip side of that is that Lemonade is working to change that. They did note in their most recent quarter that they are reducing that portion of premium that they cede to those reinsurers. So that 75% number is now more like about 70%. And I think over time, they're ultimately aiming to bring that number down significantly. And that could be good, assuming they know what they're doing. And it seems like they do. But again, insurance is a very hard business. And so all of that together, it just leaves me with a big question mark. I just don't know. I haven't been able to really fully make up my mind here.
I don't know about you, but I take a little bit of solace in the fact that the market as a whole appears to be right there with us, because you look at the 1-year chart of Lemonade, it's been as low as $44. It's been as high as $188.
Yeah.
So there are a lot of people who are trying to make up their minds about this business.
Well, and I think this could be one of those kind of generational plays, right? I mean, maybe this is a concept that's resonating more with the younger audience, the Gen Zers, right, and beyond. I mean, maybe this is the way insurance starts to work for those younger generations as they come up into the workforce. They start driving, renting, buying homes and whatnot. I mean, that ultimately remains to be seen. But I mean, at the end of the day, it really does seem like it boils down to how good their tech is, the AI and the machine learning. Is that ultimately helping them make better decisions? Because if it does, and they're able to wean themselves off of that reinsurance model, that could work out very well for them. I mean, we've seen good, well-run insurers do very well over long periods of time. I mean, they're wonderful long-term investments. It's just really trying to get a grip on whether these guys have the staying power, the brand equity, and ultimately the technology to be able to disrupt what has obviously been a very difficult industry to disrupt at this point.
Before we wrap up, our email address is marketfoolery@fool.com. Got an email from Charles, who writes, new to the show and very new to investing. I'm wondering if it makes sense to invest in 2 or more companies that provide the same product or service. For example, Volta and ChargePoint. I'm a big fan of MarketFoolery and Motley Fool Money. You all provide a wealth of information. It is much appreciated. Thanks. P.S. I must have the man behind the glass DJ my next shindig. The music selection on Motley Fool Money is second to none. Yeah, I can't help but agree. And we've gotten so many email and tweets over the last year about the bumper music that Dan Boyd picks for Motley Fool Money. By the way, Volta, interesting timing on Charles' email. I got a press release sent to me this morning about Volta just striking a deal with Six Flags amusement park. So now they're going to be, Volta's going to be the charging station at Six Flags. I don't know about you. The first thing I thought when I saw Charles' email was the war on cash basket. The second thing I thought was, of the two of the more recent stocks I just bought are head-to-head competitors, Home Depot and Lowe's.
Yeah. Well, I mean, so the short answer to the question is yes. I mean, I like this idea, particularly when the market opportunity seems really, really big. And so you said it. I mean, the first thing that came to my mind, of course, is the war on cash basket. I mean, that's ultimately why we built that thing in the first place, right? I mean, you and I were sitting there talking MarketFoolery after MarketFoolery about how well all of these companies in these payments industry were doing. And so it didn't make sense to really try to pick one winner when it was pretty apparent there were going to be a number of winners. And so when the market opportunity seems like it's pretty big, that's why I think this strategy works out even better. And just same point with your Home Depot and Lowe's example there, but just a massive market opportunity in housing. Now, not speaking particularly to these two businesses, Volta and ChargePoint, I think was it, because I haven't dug into these businesses, but from what I can gather, they ultimately are building charging stations, right? They're facilitating the electrification of our transportation industry, which is ultimately a very good thing. I mean, I think Tesla gets all of the headlines, but we have to recognize the fact that Tesla is not going to own this market 100%. I mean, they're going to be one of, I think, a number of companies that help us ultimately make this transition. So it seems to me to be an attractive market opportunity. And that's where it may make sense to consider owning a couple or 3 or 4 of the businesses that you think are really going to lead the charge, so to speak. No pun intended. Sorry about that. But yeah, investing is rarely a zero-sum game. I mean, we like to kind of make it sound that way when we're talking about these businesses because we're bullish or bearish or we're picking one over another. But the fact of the matter is that investing is rarely a zero-sum game. And I too, own a number of companies that, on the surface, maybe they compete with each other to an extent, but they are really playing in ultimately what is a very large sandbox. So to me, that is a very sensible strategy.
Let me just go back to 2 companies we talked about earlier in the show, FSLY and Cloudflare. I mean, if you went back a year and said, okay, cybersecurity, I'm going to buy a basket of stocks, and you picked those 2 along with Datadog and CrowdStrike, that's a basket that as a group is doing very well. Now, FSLY's down about 40%. CrowdStrike has doubled in the past year. Datadog up 70%. Cloudflare up nearly 300%. But again, you take the basket approach, you got 3 winners that, dull the pain of seeing FSLY down 40%.
Yeah, it can help you catch a few more winks at night, and that's a good thing.
Jason Moser, great talking to you. Thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show's mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.